Today we will discuss Sifter Fund's returns and analyze the companies in which we have invested. Our guest today is Mr. Olli Pöyhönen from Sifter Management Portfolio Management team. Welcome, Olli.
Thank you.
Since the beginning of the year, Sifter Fund's return have been 24.4%, and as you can see from the chart, we have significantly outperformed the global stock market ETF. The third quarter also ended positively with an increase of 3.4%. But in September, the market lost momentum and the fund declined by 1.4%. So, Olli, from the portfolio management point of view, how has the year progressed so far?
Well, overall, it's been a very good year for equities. The strongest driver for the share price increases that we have seen is probably the monetary policy and its effects. So essentially, the impact of those very harsh interest rate increases to the real economy hasn't been as bad as feared. So interest rates have been hiked, but inflation has slowed down or hasn't at least accelerated further. And still we're seeing a good high level of employment. So that's probably a better scenario than many of us expected.
How about sectors and the stock selection?
Yeah, well, if we look at individual sectors, clearly the strongest share price increases have been seen in the information technology sector and more specifically in the semiconductor subsector. So even though many of the semiconductor companies actually have seen their earnings decline this year somewhat relative to previous year, the reason why their share prices have still soared is because now we expect to see a turnaround, basically return to growth next year. And one key driver for that increased optimism is that, we have seen all the things that AI can do, and all the demand for those exciting AI services is expected to boost the demand, particularly for the most advanced semiconductors. So overall, that's what's driving what has driven the quite sharp share price increases in the information technology sector.
So good year for the stocks, but how about Sifter Fund? What has contributed to Sifter Fund's returns in particular?
Well, if we look at the overperformance, like year to date, one traditional way to look at that is to analyze it. How much of it originates from our allocation of funds across different sectors, and how much of it originates from a good selection of stocks within sectors. So year to date, about half of the overperformance is due to good selection of stocks within each sector. And the best example of that is Novo Nordisk that has clearly outperformed the healthcare sector with its quite sharp share price increase. Now, the other half of the overperformance is due to our allocation of funds across different sectors, and more specifically our overweight in the information technology and semiconductors. Now, but at this point, it's good to remind the listeners that Sifter doesn't really have a strategy of allocating a certain amount of funds in a given sector in general, but the reason why we have this overweight is in semiconductors is because that industry just tends to have a lot of companies with strong entry barriers, strong competitive advantages, and they have been available at a reasonable price at the time of investment. So that's, I think, important too.
But that was like the whole year. But if we look at the third quarter, and we can see that the IT and techno stock have declined mostly.
Yeah.
Still the fund has outperformed. So
true.
What is that story?
Yeah, if we don't look at the full kind of year-to-date picture, but just zoom into the third quarter, well, there indeed we didn't have that tailwind of generally rising information technology stocks. Our overexposure in information technology was actually a bit of a headwind. So, but we still overperformed the market. And that is then entirely due to our good selection of stocks within sectors. So we have several examples. Novo Nordisk continued to be a good choice in the healthcare sector. Our strongest pick in the industrial sectors was Old Dominion, but we also had other good choices there. And then in communication services, UMG was the best selection for that period.
Right. So let's talk more about the gainers and decliners in the third quarter. And we can see that Disco and UMG and Autoliv were the biggest contributors in the third quarter. And then on the other hand, we have decliners SMC, TSMC, and Texas. So let's start off with the Disco Corporation. It's one of our oldest semiconductor companies, and it's a specialist in a niche market. So could you please tell some explanation for the sharp share price rise in this year and particularly this quarter?
Yeah. So what Disco is essentially, so it's a niche player, as you said. So they make equipment which are used to kind of grind silicon wafers, and after you have kind of created these microchips on it, then Disco's equipment can be used to kind of dice them, to cut them out of the silicon wafer. So it's very much driven by the just the overall volume of chips and overall volume of silicon wafers that the semiconductor industry produces. So you wouldn't expect like very strong shifts in earnings, particularly when they sell also consumables, which smoothens those cycles further. But now it's becoming increasingly clear over the past few quarters that this company benefits from the increasing demand for power semiconductors. So that's a specific type of semiconductor which is used to transform and switch electric currents, and the demand for those is driven specifically by, or particularly by, electric vehicles, the proliferation of those. So there's that kind of a growth driver. Power semiconductor, as I said, are just one fairly small portion of the overall semiconductor market. But for Disco, they represent, or those kind of use cases represent about a third of Disco's equipment shipments. So this niche player happens to be exposed to a further niche, so to say.
Niche in a niche.
Yeah.
It's a very focused player.
Yeah, so that kind of a tailwind is now ongoing. And then another tailwind of which Disco has shared somewhat less information, but they see that they also benefit from the manufacturing methods of these AI processors. So they expect also equipment orders related to those. So yeah, a handful of good news indeed.
Yeah, it seems positive thing for Disco. But then we have another totally different business, UMG, our second biggest gainer in the third quarter. So it's a relatively new company or addition in Sifter portfolio, only a few years. So what has contributed to UMG's share price?
Yeah, well, in Q3, we got a lot of new information which kind of alleviated some of the concerns that we had at the beginning of the year. So at the beginning of the year, the investors were quite concerned about the fact that AI could create such good music at such high rate just by imitating artists and their lyrics. And that kind of raised concerns that maybe this could attract listeners from UMG's own content to maybe this new kind of content. But what we have seen from the actual business results of UMG is that business continues just as it has done before. So the income stream from music streaming services continues to grow. And actually, now it's not only growing through a larger number of people who pay for music subscriptions, but also due to the growing price of those subscriptions. So earlier last year, we already had Apple Music hiking prices. Then we had Amazon Music hiking prices. Then we had news of Spotify and YouTube Premium also hiking prices, all more or less 10% or so in main markets.
And UMG kind of like gets the bigger cut out of that royalty.
Yeah. Yeah, so the music streaming industry, if you think about it as a cake, the cake is growing. So UMG's slice is also getting bigger for that reason. So one way maybe to look at the AI-generated music is just that it's just one form of new music. And we already had a huge oversupply of music even before AI created any of these songs.
Right.
And, the listener only has a limited amount of time during a day to maybe find a new hit among maybe more or less good songs. So in that sense, the dynamic hasn't really changed. UMG owns a lot of the hits and classics, evergreen pieces of music that the listener knows they will enjoy. So they still have that asset.
Okay, so it seems to be quite predictable business in that sense.
Yeah.
Quality business. Oh, by the way, would you listen to AI-created music yourself?
Well, it's a hit and miss. Some of the songs are pretty good, but really, I don't have time to find the good ones. So, yeah.
Good. Well, those were the biggest gainers in the third quarter. But how about the decliners? We have SMC, TSMC, and Texas. So two of them are semiconductors, and SMC it's perhaps the most unfamiliar to many. Would you please describe a little bit about the SMC's business and the reasons behind the stock price decline?
Yeah, absolutely. So SMC, that's a Japanese company, and they make these components for pneumatic systems. So systems which work with compressed air, essentially, and those systems then are used to automate factories. So that's what they do, just make components for those. What happened in Q3 is that, we had a lot of negative news from the Chinese economy and the way that that economy is recovering after COVID lockdowns. It's not going as well as it could have been. And that's a meaningful headwind for SMC. A quarter of their revenue originates from China. So, it's going to be a headwind, at least for the short term.
How about the business characteristics of SMC? Is it still quality business? What do you think?
Yeah, it is. So that's why it's in the portfolio. So they have a 40% global market share. They have a very strong net cash position, and they are also very well present across the globe. They have very well developed supply chains, and that was a big advantage during the when the supply chains broke down during the worst of the Corona crisis. So now that the price dropped in this way, we actually saw that the earnings, the return potential improved. Particularly because SMC has guided that they actually have a pretty healthy growth outlook for the next 4 years, growing at about 7 to 8% their top line over that period, partly driven by semiconductor industry, partly driven by battery manufacturing, particularly in Europe and North America. So, over the long term, the business, we would expect it to do just fine. And therefore, we made this additional investment.
Now, what would you say? What is the weight of the current weight? Is it like an average or above average or?
Well, it's a bit below average, so still not very large. But no longer as minuscule as it was earlier.
Right. Okay, good. So we have better conviction of the SMC now. Let's talk about risks a bit. We've been doing quite well in this year, and also during the last 5 years, the fund has ranked among the best in the world in its own category. So naturally, it raises a question that if there are risks involved in the investment style, and how do we mitigate risk regarding equities and the investment style and that's on?
The strategy has a lot of those filters or sifters, as you might say. It's first and foremost, the companies that we pick have to be quality companies. So they have to have strong competitive advantages. They have to have a stable financial position. They have to have kind of predictable earnings, and they have to also have growth. So the earnings must be growing. It can't be a stagnant company. So that already kind of mitigates the risks a lot. And then we are left with valuation. And even there, we also have pretty strict controls. So we forecast the earnings 5 years into the future and use kind of moderate, cautious estimates. And we compare that earnings then to the current share price, not next year's earnings or the previous 12 months, but 5 years into the future. So that already mitigates a lot of risks. So it allows us to avoid some of the kind of biggest risks in terms of valuation. So NVIDIA, that's not in our portfolio, and at the current state, I don't quite see it entering it. It was expensive before this year, and it still is. Even if we use 5-year forecasts into the future, unless we forecast that the earnings per share roughly increase roughly tenfold. And while that's maybe possible, it's not cautious, really.
I think our margin of safety wouldn't allow that.
Yeah, no,
so how about the very cheap stocks? That's the other kind of like a risk, possible risk.
Yeah, kind of a value trap.
Right. What is value trap?
So that's a company that seems affordable, cheap even, but there's a reason for it. So the earnings stagnate or just grow very slowly or even decline.
Yeah.
And that's not a very attractive company for a long-term investor. So that's because the share price can't really deviate too far from the actual earnings that the company makes over a long term. So just if the earnings just stagnate, it just kind of creates sort of a ceiling for how high the share price can actually get, apart from some very outlier cases that we have seen.
So one could say that Sifter investment style and strategy is risk averse in many ways. We mitigate like a hyped valuation stocks, like very expensive ones, and on the other hand, very cheap ones, and concentrate on the focus quality businesses.
Yeah, there has to be earnings growth. So that's the filter that kind of helps us avoid those value traps.
Okay. Well, coming back to this valuation and that, how do we rebalance the portfolio regarding valuation? If, say, for example, if one company, the stock price increases too much, and then what shall we do?
Yeah. So we constantly have this view of our portfolio as kind of a ranking that we have those companies with the highest risk-adjusted return potential at the top, and then the ones with the lowest risk-adjusted potential at the bottom. And if we have just one example where the share price increases a lot, but then our expected earnings for it don't really change, then that just means that there's less return potential there. And if that kind of a company would move downward in that ranking. And when we look for new candidates for the portfolio in the broad investment universe, and if we find something, those companies in the lower portion of the ranking are the likeliest ones to get kicked out when we introduce something new to the portfolio. So that way we kind of get rid of the too highly valued ones.
So we try to keep the portfolio evergreen, so to say, regarding valuation and improve the business characteristics.
Yes, yeah. And sometimes the share price though increases so quickly that we don't really have time to look for another candidate. So one example was iRobot, which was sold at the beginning of 2021 after the share price, I think, doubled in less than a week without any change in the underlying business. So in that case, it was sold immediately without looking for an alternative.
Exactly, just sell it.
Yeah, just
otherwise we keep the businesses or hold them, but in that kind of like a extreme cases, you sell.
Pretty rare, but
only once.
Only once so far.
Good. Well, no, that's about the risks. But how about can this kind of like good returns? Can we continue? Is it possible?
Yeah. I mean, if we continue to choose this find these quality companies, and we expect their earnings to grow over the long term, it's not an unreasonable expectation to also see their share prices increase, assuming that all the other factors in the economy stay constant. So, but really, that's the only thing that we can say, and to really put it a little bit more bluntly, that we can't really promise anything. We only expect earnings growth.
That's right.
And,
that's our favorite mantra. We promise no returns.
Yeah.
But what we can promise is that we will continue with the same investment strategy. Invest in quality businesses in all market conditions. Right.
That's right.
And we expect, or our hypothesis is that whenever there's a earnings growth, so the stock price growth might follow. And that's basically what we can promise.
Yeah, that's a reasonable expectation, considering that all the other factors in the economy stay constant. So
yeah. But it's been a really difficult time for market timer the last 5 years.
True.
All kind of macroeconomic changes and surprises, mostly negative. But still, we can see that the very good businesses, quality businesses, they can thrive on this kind of, even in this kind of environment. It's really interesting.
Yeah. During good times, the kind of tide lifts all boats, but during the difficult times, we can see which boats were actually solid.
Yeah. That's a very good way to end this discussion. And we thank you, and we will see in January when the whole year is backed, and luckily and hopefully we are able to present a couple of new investment cases. We've invested in Sifter Fund, and hopefully good returns as well. Thank you very much.
Thank you.